What's up, guys? Welcome back. I'm Tom Crown. Thank you for joining me on Friday. It's a largely unspectacular price action day, but we have some really interesting things really on the radar that we found out this week. Big things actually happening today at close, and then some crypto specific spicy news. So if you guys enjoy the content, you enjoy these streams, please smash the like, subscribe, join us. We're going to do our best to make today interesting. The timeline is absolutely dead, but we're going to try to liven it up here just a little bit. So in the title today is the quadruple witching. Very spooky sounding thing. This happens 4 times a year, and this is essentially when we see stock index options, singular stock future. This is going off memory here. Singular stock options, stock index futures, and index options all expire for the quarter, and we see huge expirations today in the trillions. Now, it's trillions of dollars don't actually like pass hands. It's not actually what's happening, just a fraction of that, but still in the tens or hundreds of billions of dollars. The quadruple witching is certainly a day where you can see market trends change. This happens it's March, June, like September, December, something like that, at the end of every quarter on the third Friday of the month. And that is today. So bullish, bearish, I don't really know. I guess we can say that maybe the market's going to see a little shake up here into next week's open, and I would definitely welcome that. On Wednesday, we covered 𝐂𝐴𝐽. It was the greatest, most important, biggest FOMC of our lives ever. And you were all here for it. What a wild stream. Thanks, guys. I appreciate you. While we didn't get any interest rate cut or change, or even really any forward guidance on when that would happen, we did get some interesting news that may be more bullish. We saw a commitment from the Fed to reduce balance sheet runoff from 25 to 5 billion. That would be a direct reduction of 80%. So this isn't an end to quantitative tightening, nor is it a beginning of quantitative easing, but it is a transition to the end of quantitative tightening. And that's really what markets everywhere are looking for, that sweet money printer to turn on and to pump all of our bags, every single one of our bags. That was Wednesday. There were still mortgage-backed securities, so I think they're still doing it's like 30 billion, I think, a month. But that is still a significant reduction, and it's a step towards finally exiting quantitative tightening and entering quantitative easing. Let me see. There was a few other things I wanted to go over here. Big stuff going on, and this is in the crypto world. SEC coming out with this study, this statement on proof of work mining activities, basically declaring them not securities. And while I think it's safe to assume that already, that they were not securities, this is showing at least like a follow-up, a commitment, something continuing to happen here. You know, the SEC putting it on paper in pen that the activity of mining is not a security. And I'm a big fan of that. I'm a big proof of work guy. In fact, to my own detriment at times, I love my proof of works. I love my mining. And it is absolutely bullish to see the SEC come out and just give any amount of clarity here. I haven't read the whole thing yet. I probably should. If you guys have, definitely weigh in. Let me know what you think about that. Certainly can't be viewed as bearish, in my opinion. Further in the news, here we go. I'm just waking up, man. I went out and hung out with a friend I haven't seen in a long time last night. I'm feeling a little rougher. But I'm waking up. I'm feeling a little better here. This is the kind of blindsided part for me. Did not expect this. To my knowledge, OFAC has removed Tornado Cash from essentially unbanning it, essentially like not taking it off the sanctions list. Did not see this coming. Man, I have mixed feelings about this. As a largely maximalist in the crypto space, crypto can be used for good, it can be used for evil, and unfortunately it's not up to us. It's only up to us how we use it. With all things and all technologies, they can be used for good or bad. And when they added Tornado Cash and these mixers to sanctions lists, it definitely took away from privacy in this space. It definitely was against the ethos of crypto in general. I just kind of wonder beyond that. Why? We just saw North Korea, and it even says North Korea here. I don't even know how to read this document. It's just like a bunch of addresses and stuff. North Korea just stole $1.5 billion worth of ETH from Bybit and then basically mixed it. With like a big hack like that, it seems like an odd move for the U.S. Department of Treasury to move this way. I certainly support it because it is against, again, the ethos of Bitcoin and crypto. But like, it just seems like an odd move to me. What do you... Oh, I guess, and they also removed North Korea? I don't know. I don't know how to read this. It's just a bunch of addresses and shit. But that's what I'm hearing through the channels, is that now those mixers are no longer sanctioned. They're no longer, I don't know, taboo. I believe it is illegal for U.S. citizens to use Bitcoin mixing software, programs, whatever. At least it has been. I don't know. Maybe this is a step in a different direction. Privacy, definitely need to protect it. Definitely value privacy in this space. And unfortunately, privacy means privacy for the bad guys too. You can't have it one way. You can't just have just the good guys have privacy. Does not work that way. Does not. I think that's like kind of, is that what I had for you guys? We have 𝐂𝐡𝐚𝐫𝐭, quantitative tightening, unwinding. The SEC coming out and clarifying mining activities as not securities. We have tornado cash. Yeah. Is there anything else? Quadruple witching. Yeah, I don't know. Is there anything else in the charts? Well, the charts haven't freaking moved. Here we are. A little pop and rally off of the FOMC on Bitcoin, setting a slightly higher high. I don't think anything has changed in this short term, in this kind of call it consolidation here. Basically, our lows have been coming up. Our resistance is being tapped, tested, broken at 85-ish thousand. We've made very, very little progress in any direction other than to the right, pretty much all through March at this point. I still see this as resolving to a little move to the upside. I don't think that that's complete, but I also don't have high hopes that this is elevator straight to Lambo, straight to a million. I think that this is likely a higher high, and we'll kind of see what happens as we roll into April. I heard there was some uncertainty, seemingly the magic word for the markets lately, some uncertainty around the tariffs that are supposed to take place or activate April 2nd, not April 1st, because then it would be a joke. But April 2nd, apparently, maybe Trump saying, walking some of this back, doing something. At this point, I can't keep up as to who's getting tariffs and what's being tariffed. If we've said it's happening or not happening, I don't even know if it like matters at this point, the specifics, other than we're not certain. We're just not sure what's going to happen. I've told you guys how I feel about that, kind of expressed my views on the uncertainty of the market with these tariffs, not tariffs. We're doing this, we're not doing that, plans being very difficult to create for businesses, making not really the best environment for growth. We don't have to cover that again. I don't know if you guys have any extra info on that. That'd be interesting. Coming up here, what do we got? March. Let's go through April. So we are on the last week. Next week is the last week of March. Does not look to be the biggest numbers wise. The U.S. confidence, new home sales, those are big. We see CPI for Australia and the UK. Not quite as big as the U.S., not quite as important, at least when it comes to the final global economic scale, but still important to see what the rest of the world is doing when it comes to inflation. Down the list, durable goods. We have some FTC commissioner speaking. Blockchain Summit. Okay, I didn't know this. On Wednesday, March 26th, DC Blockchain Summit. DC is not that far from me. Maybe I'll make a day trip. We'll see. It's kind of an annoying travel, but maybe I'll make a day trip. Maybe not. Maybe we'll stream. U.S. final GDP quarter over quarter coming in. Man, we do not. Bitcoin futures expiration. 28th of March. I've never seen this on an event calendar or on an economics calendar. That's cool. Shout out to CryptoCraft. Good free site here. And not a lot. Daylight savings time shift. Wait. Other countries do daylight savings time? That's unfortunate. That's unfortunate. I guess there's not a lot going on today. It does seem like the timeline's dead. Seems like everyone sick of this bullshit. I feel you. But we're here. Remember, there's nothing wrong with taking a break. Walking away, getting your mind off of crypto for a little bit. It'll be here when you get back. Roundtable crypto today. Where's that? Where's that, my friend? GT nuts. Is that a wow? I gotta turn the heat off in this room. One sec. Getting blasted by heat. All of a sudden, it's like 30 degrees out. It was 70 yesterday. Now it's 30. Blasted in the face. SEC Roundtable. Where is it? Are they streaming it? It's interesting it wasn't on that. Let me Google. SEC Roundtable. Today at 1 p.m. So that's happening right now and we're not watching it. We should probably start watching it. Crypto Task Force. Oh, we got out of defining. All right, I guess let's throw this up, right? Hey, we haven't missed anything.
A bit of a model for what we're going to
do. Ooh, maybe we have missed something. I was going to say, it looks like they're late as usual. All right. Let's throw this up for now. Maybe change the title.
Do today, which is we have to get the tractor running. We have to address those definitional questions, which are so key to so many of the other questions in this area. And they will allow us to then build a functional and efficient shed, which is the regulatory framework. And I think these people are as adept as my brother and his friend, so I'm excited to see what lies ahead. We do have some foundational questions I think that we can talk about today. Obviously, what makes something a security? Is that status permanent, or might an asset start as a security and convert to a non-security, or vice versa? How does decentralization affect our analysis, if at all? Can we translate the characteristics of a security into a simple taxonomy that will cover the many different types of crypto assets that exist today and may exist in the future? So thank you to everyone who made the roundtable possible today. There's been a lot of work that's gone into it by people throughout the building. I'm looking forward to the conversation. And I'm going to hand it over to our former Commissioner, Troy Paredes, who's going to moderate this group. And I'm really looking forward to the discussion. Thank you so much.
Stumbled into a gem. Thank you for the tip, guys.
Thank you. Thank the entirety of the Commission for not only hosting this, but certainly for the opportunity afforded me to moderate. I'm looking forward to a lively and engaging conversation, and it's certainly great to be back at the Commission. The panelists have lots of different views, and I think that's what makes for a great panel. And if everybody was of the same view, we probably wouldn't need to be here, and the Commission wouldn't have seen fit to host all of us today. So it should be a great conversation. The goal, very much consistent with what's already been said, but just to offer a particular take on it, is a very simple starting point from at least my perspective, which is everything is something. And it may be a security, but it may not be a security. And so as I've often thought about it, this what is it question, or perhaps more aptly put, what are they question, has never been, I think, more front and center in the history of the federal securities laws, at least not insofar as I can consider or recall. I've taught Howie many times back in my law professor days, and I used to teach it out of almost a sense of obligation. And then all of a sudden, wow, it's one of the most important cases in the history of Supreme Court jurisprudence involving the federal securities laws. So it really is amazing to see how things have continued to develop in the context of securities regulation and otherwise, and that's no small part because of what the pace and magnitude of innovation has been over the last handful of years. So as was mentioned, the focus today is on what's security, how do you define it, and what does that mean, particularly in the context of crypto assets, sometimes called tokens or digital assets. I'm sure we'll use those words interchangeably. Before we jump in, let me walk through some game plan so that everybody is on the same page. I'll run through a number of items. I'll do this quickly, and then we will get into the substance. So here's the game plan. I'm going to call on people. The first three, though, and I've not told them this yet, but they're about to hear. So the first three, so no one's caught off guard, are going to be Chris, and then Teresa, and then Sarah, and then we'll proceed from there. Next, in the initial go-around, I'd ask that you keep your responses to a couple of minutes or so. There is so much for us to get into, and the conversation is sure to be engaging and interesting. So we want to make sure we have plenty of time for you all to engage with one another. When responding, just your name and affiliation. Your bios are available on the Commission's webpage, extraordinarily impressive bios. So if you can just give your name, your affiliation, and encourage folks to take a look at the more complete bios that are available. Please keep it engaging and interactive. Feel free to react to folks, respond to folks, riff off what somebody else has said. If you need to get my attention, my, I guess, ask is lean forward, wave your hand, stand up, whatever it is, and get my attention. You can also, pipe up, and everybody will do that in a respectful way, I'm sure. If I interrupt, it's only so we have plenty of opportunity to hear from everybody. Okay. I hope I don't have to interrupt, but I won't be shy if I need to make sure we hear what everybody has to say. I would ask also that folks be as precise as they can be and define their terms. One of the things that I personally find challenging is there are so many new words or different words. Sometimes folks use the same word to mean different things. Sometimes folks use different words to mean the same thing. So I think if everybody understands precisely what it is that you're referring to when you use a particular phrase or a term, I think that'll help motivate the conversation as well.
Don't use
In addition to saying what you think, I would encourage everybody to say why you think it. I think that's a key part as well to make sure the conversation flows.
Troy.
A few final quick game plan points. I'd ask that you don't make any specific reference or even innuendo, if you will, to actual enforcement actions. And so keep it general if you're talking about anything that touches on something that might be related in some way or another to enforcement. Commissioner Peirce and the members of the task force, if there's something you want me to do, feel free to come up here and tell me to do it. I'm happy to take instruction. This is really about a discussion that's most useful for all of you, and so feel free to pass me a note or raise your hand or whatever,
a lot of words.
And chime in any way that's helpful. I think we go for about an hour and a half, and think until 3 East Coast time. So we'll keep to that. Then we'll have a break, and then after the break, my understanding is that there will be questions that folks have submitted from the audience, whether it's folks here who are joining in person. I think there's a way to
He's calling me,
submit
Mr.
written
Troy.
questions, and I think for folks who may be watching and joining us
Who are
online, my understanding is if you were to email, and Samira or somebody will tell me if I'm wrong on this,
He's from
crypto@sec.gov.
LLC. I have an LLC.
Then and if you put in the subject line roundtable question, then we'll be able to take those into consideration as well, and we'll work through those during the break. At least some of us will, and then be ready for after the break. Final point is there is more to it than Howie. Howie gets a lot of the attention, and for understandable reason, but there's more to it than that. And so certainly encourage folks not to feel as though this is only a discussion about Howie. It's a broader discussion by nature. But there's more to it than a key part of it. So with that, encourage folks not to feel. Let me turn, as I indicated, to Chris. So Chris, you have a unique perspective, being a professor as well as a CEO of a company, as well as the opportunity to sit on a few different boards. What are one or two considerations that you think should drive the determination as to whether a particular crypto asset is or is not a security? And to what extent, as somebody yourself who's thought a lot about disclosure that's related, how has your thinking about what's the most relevant disclosure when it comes to crypto assets or different kinds of crypto assets informed your assessment?
Oh my God, let someone else talk.
So thank you for that. My name is Chris Brummer. I'm a professor over at Georgetown Law. I am the CEO of Blueprint, a crypto disclosure company, and I am the former good friend of Troy for making me go first. So
I think we're still good friends, no?
Hilarious,
Okay,
hilarious guys. Such great banter. Keep moving.
Let me just go for a little bit of a running start, because it's important that this kind of conversation is difficult because we're all, on the one hand, a little bit of philosophers because we're talking about the nature of securities law, but we're also auto mechanics, which I take as our objective to come up with some actionable road items. when I think about putting on the philosopher hat for 15, 20 seconds, when I think about the Howey test, just in general, because that is sort of this over-encompassing standard, it's a lot smarter than people would think. Certainly there are some limitations when it comes to crypto assets, but the logic behind it is actually pretty interesting when you think about each of the individual prongs. Ultimately, each of those prongs represents a kind of a risk that the gods of securities law have said when they are collectively there, we're going to mandate disclosure, as Troy had mentioned. We're basically saying when you have savings, there's an issue of investor protection.
These are on there.
The common enterprise prong that we're all familiar with is really addressing a kind of a free riding problem, almost like when you teach to a large room of students and you ask them to raise their hand and nobody raises their hand. Everyone's being a very rational actor. And so it goes to this question of whether or not there's going to be an under-provisioning of information. The efforts of others prong, it really just goes to information asymmetries. And then the question of sort of profits goes to investor psychology, greed and fear, the kinds of things that can distort decision making. And basically, when you have all those factors together, you have a mandated disclosure requirement. Now, many of those factors, I would say, are this is a very old rule. This is right after the New Deal, and it's premised on pieces of paper and the kinds of risks that accompany transactions when information was distributed through pieces of paper. When you move to any kind of new technology, we're obviously talking about crypto now, but certainly a digital technology, the underlying risks relating to each of those prongs can change in different and interesting ways. And so when you ask me what am I actually, or what do I think a securities law regime or any kind of regime for crypto assets should look like, it should certainly address the fundamental sort of risks that would involve any kind of transaction when you have a collectivity of these underlying concerns, but it also has to address the changes of the technology, the backdrop behind which the transactions themselves are being consummated. This is not just a question of whether or not the regime is efficient for the market, but it's also how do you best protect investors. And I think that the two sort of key characteristics are what are the specific risks? I'm going to break it down to three. What are the particular risks? Are those risks reflecting this sort of old 90-year-old regime in terms of the sort of meta concerns? And then are there things that are interesting about the technology that require adaptation to those risks? Questions like predictability, which has not always been Howey's strongest point, become more important when you're dealing with a technology like this because you're talking about digital information, information that can be programmed, information that can be embedded in different kinds of transactional systems, information that can be used to comply faster, easier, more effectively. So what does that mean in terms of our analysis? In terms of the overall reach, last little bit.
It's got to be high.
Point. Securities have always, I have a job as a securities law professor because I can give exams where things don't fit neatly into a category of securities law. That's you guys may take that job away.
Thank you for explaining why you're a teacher.
But ultimately, it's in that gray zone that there's always been some kind of ambiguity, but does the ambiguity sort of rise to the level where you can no longer sort of build things? And when it does, you have to do a little bit of an assessment about what are the risks, what are the opportunities. We already heard that before. And then to think creatively and to build systems like you have iteratively to deal with those. So I'm looking to see that in a particular regulatory system, and there are many ways in which an auto mechanic can get this done. But they have different kinds of trade-offs, and I'm sure we'll talk about those trade-offs.
Somehow this is making Jerome Powell's speech
semester/session
sounds so riveting and exciting.
Thanks, Chris. Teresa, so you have the perspective of being in private practice and doing enforcement-related work as well as transactional related work. And as I understand it, you focused a lot in your thinking on the topic we're talking about today around things like rights, duties, other characteristics and attributes that attend to a particular crypto asset or some arrangement, think about it from an investment contract perspective or otherwise. So can you expound upon that aspect and the ways in which right, duties, characteristics, features, whichever word or words you think are the best to use, are informative?
Good. That's a really great point, guys. This is, for those of you tuning in and very confused as to why this is even more boring than usual. This is the SEC Roundtable on crypto regulation. And someone pointed out here, and I really think that this is a valid point. This table is not round at all. This is a very square table. It's very rectangular. And I feel like we're already off to a rug.
To the determination as to whether or not there is or is not a security, and how does that align? Does it align, or is it a different approach and perspective from what Chris was saying in terms of starting with the risks, right? As I understood Chris's point was you got to start with the risk and do some version of a risk mapping. Not that that's the only thing you do, but that that's an important piece of the overall assessment. How does your perspective align with that, or is it a different take on the question?
No, thanks so much. And I'm Teresa Goody-Guillen, a partner at Baker Hostetler. So I agree with Chris in that I think that risk mapping is an important part of the analysis. My analysis starts at a different place, and it's a much more fundamental level. And looking at it, and I don't want to get hung up like on too many words with, what is a right or an interest. I am using Black's Law Dictionary definition if anybody wants to know what I'm referring to, which is very broad. But, in looking at this, what are these? And I think that's exactly what the question is. And they can be many different types of things. And I think it's a looking at what are the various rights and interests and obligations that are a part of them, that come from them, that they represent. So, and I take it kind of looking back historically, when have we gone through this before? And when have we developed, a business form, a new business form, and how did we approach that? And when new assets have been created, how did we analyze them? How did we group them? How did we just determine how to regulate them? And, first it starts with, these interests, and I'll talk about it a little bit deeper in a second, but those rights, interests, obligations, anything that's there. Because everything is something. It's not just nothing. Air is air. It's not nothing, wow. Right? So there's everything is something. Deep. And then by looking at that, you can start to look at these different types of relationships and transactions. And it's a much deeper kind of analysis than I think, is people are kind of engaging a lot of the time in. It's a very much more basic level. And from there, you can look at what then are like the risks. What are, there's always some sort of an assumption of risk when you have any kind of a transaction. And that's kind of what the negotiation is. Somebody bears some sort of risk, and there's usually some sort of economic incentive, or there's some incentive for that. And then from moving forward, how do these things move together? What are their characteristics? How are they similar? How do they move in a market? Like commodities in stocks, and how does that work? Like you can see that some things are correlated, some things are not. When there's high inflation, you see more commodities being purchased. And so there's an interrelation between all of these things and between the people. So it's not just the assets, it's also the relationship between all of the different actors. And just because I'm not acting myself, but I'm acting through some autonomous something, or I create something that then can go out and behave on its own, that does not mean that it doesn't exist because there's no human. Like it always starts from a human, right? And if I do something, if I put some code out there and it creates something, that becomes there's some sort of warrant of merchantability, there's some sort of fitness of use. Like there's lots of different theories of property, of economic principles of the law, of business forms, of torts, right? Reasonable person duty. Like, you still have duties that may then be, you may breach, and it may proximately cause somebody else's injury. And if I do that through, a human being, or I do it through something else, it's something that's autonomous, you still have to think about how all of these things work together. And if you go back and look at when a corporation was first created, the corporate form, originally, it was me, I had a business, and I operated that business, and I was fully liable, my person. You could come after my house. Then we separated out liability. And then I had me, my business, but you could only come after my business. My house was safe, right? And then we separated this, and with shareholders, with ownership being separate from control, and instead of groups of people putting their money in and all working together to do something, they started getting other people to invest. And it's actually, in the grand scheme of things, not that long ago, in 1904, there's this Corporation Commission report talking about the experiment of a corporation and all these various incentives, thinking that the law went too fast, and it created this, these incentives that weren't aligned, and created market issues and fraud and all these other things that we learn about. We talked about for the 29 crash. And they had to look at and these questions of, this is new. If I separate wealth, my property of wealth, if I'm separate from it and I give it to somebody else to manage, do I still have those same rights to that wealth that I used to have, that I had when I was doing it? And this was a question that had to be answered. And I think similarly, we're reaching a point here where there are some of those very fundamental questions we need to answer. And so, for example, if you look at it as, and this is not my idea, this is Adolf Berle's idea, but if you have, thinking of a shareholder as having passive property, they don't do anything with it, and you have the manager having the active property because they control it. He thought, what happens one day could you have a property interest in that active property? And I think that the DLT is what created that ability, and that is a new right we haven't seen before. So particularly with governance tokens, and not all, even governance tokens are different. So that's why we really have to think about what are these, because so a governance token is kind of unbundling and debundling of things that we've already been recognizing. And so I have the ability in a very small part to control with my vote. And then, so I own it and I'm controlling it, but only a very small part, so I don't really have the ability to do a big change unless I'm with a bunch of other people or I own a ton of it. But generally speaking, that's what it is. Right. And that's tradable. So this is now a property interest in active property, and we've never had it. So okay. I think it's at least worth asking, what is that? What does that mean? Okay. How should we think about that? And getting to really to do that, and how the securities laws applies is to ask, what is the sine qua non of a security? It's not Howey. Howey's the definition of an investment contract. There's lots of other things. Howey does not apply to evidence of indebtedness. Howey does not apply to voting trust certificates. That's not the test. And so I think we need to look more at what is it. There's some sort of an economic interest. And if you think about these DLT networks, not as just some piece of technology, but more in the fourth kind of industrial revolution we're in, as a new business form, a new way of doing things, a new way of allocating resources, it becomes much bigger than that, of thinking through what these actually are. And I encourage everybody to dig a little deeper in trying to figure out what they are.
Send
Great,
dominance
thank you.
higher still.
So we have Chris, I'm paraphrasing, and I'm sure I'm going to get things wrong here, but Chris talking about risks, and Teresa talking in a very fun way about rights, duties, obligations, raises questions about under what circumstances does somebody owe obligations to others, and in a way that gives rise to legal liabilities, and how does that through an obligation responsibility, how does that flow through in terms of thinking about jurisdictional questions, like what's a security? And then, Sarah, I'd mentioned that you were going to be third, and you have a different perspective insofar as you're general counsel. And so how do I have that right?
At my job?
Yeah.
Okay.
Yeah, at your job. Yeah, sorry.
I do a lot of things, activism on the side. I didn't know.
Oh, okay, yeah, so I was thinking about that job. Sorry about your job, if I got that right. I think I have that right.
She kind of looks like Gina.
So you're dealing with these things in a very practical way is the point, which is a different vantage point in terms of being House and having those responsibilities, a different vantage point. So what's the biggest challenge that you face in trying to wrestle with this question as to whether or not something is or is not a security? Because to make a implicit point that's come through Express, the security question is so consequential because it determines jurisdiction. It determines regulatory jurisdiction. So it's not, yes, it's an interesting academic question, but it's a very practically consequential question. And even if it's not a security and therefore there's not jurisdiction by the SEC, well, then it's, again, something, and so somebody else has got jurisdiction. And so how do you wrestle with that? What's the biggest challenge wrestling with that? And is there a particular
double leg
thing
takedown
that you think the commission could do or should really consider doing that you think would really move things forward, not to the exclusion of other considerations, but one that may really stand out from your perspective?
So I think that the specter of the application of securities laws has moved early stage projects in the market to sort of take an arc very similar to IPOs where they stay private longer. These assets in the traditional model are designed to have wide, broad, early distribution. And most of the market is hedging that on the application of securities laws, so it ends up looking a lot like your traditional markets where people will basically marshal, their way to an exchange listing without that broad dissemination or price support or, actually fully launching the technology. And we see more and more the token is the product. There's attention economy models, and prices being more, I guess, there's different ways that people are artificially supporting price, like the high FDV, low float model that's come, and it's generally been, I'd say, sort of toxic to the market with everything structured to avoid
crazy boring.
Intricate structuring to I guess, hedge downside that you're complying along the way with securities laws just in case it is deemed to be a security.
Yeah, this is like
And so to
a
pick up
different level of
on
boring.
that, now, John, I'm going to go to you.
What are they even saying? It's like it's not clear to me they're talking about crypto. They're
From
just
your
talking.
perspective, having heard Chris's take, Teresa's take, Sarah's take, three different takes, and I think that's the whole point here to see the different perspectives on this. From your perspective, John, you've had a lot of opportunity over the years to think about the intersection of technology and our capital markets and technology and finance and securities regulation beyond just right now in the context of blockchain technology and crypto assets. So how would you suggest that the commission adopt, if you think they need to adopt or adapt, a technology neutral approach to the question of what's a security? And very much related to that, are there circumstances under which you would say, well, if a particular crypto asset had these attributes or rights or obligations or interest, or a lack of these attributes or rights or obligations or interest, or to pick up on Chris's point, these risks or not these risks, that you would say without being perhaps conclusive about it, well, under that condition, that particular crypto asset most likely would not be a security?
Well, thanks, Troy. And thank you for everyone. And I'm really honored to be among this group. It's an incredible group of attorneys. And Commissioner Pierce, who I knew when she was a staff attorney, I can't say enough amazing words about her and about this task force. I think it's an incredible idea to really recommend and figure out what you want to tell Congress with respect to securities regulation. But I don't see it as something you can tell the courts, because the courts have already spoken. If you look at the statement that I wrote, and I know the statement that Professor Reiners wrote, as far as what is a security, the economic reality of the transaction, however you want to look at it, the people buying crypto are not collectors. We all know that. They're investors. And the mission of the SEC is to protect investors. And how do I know they're investors? Because whenever I go around and talk about this stuff, whether it be on Twitter, X, whatever you want to call it, in a big space, or on 60 Minutes, you know, I get death threats afterwards because I'm talking literally, because I'm talking about crypto and that it should be regulated. And whether you're talking about eel farms or ostrich farms or orange groves, the whole point of securities regulation was to wrap that all up into a very big, broad, principles-based regulation. Principles-based regulation works. And if you read all the cases that I cite in my statement, that Professor Reiner cites, I don't think the SEC, with respectfully, can just suddenly say, all these cases don't exist. We've decided that the law is different. The law right now talks about the principle, the fact that the 33 Act and the 34 Act were written to be flexible. And this kind of criticism has been around for a long time. You know, coming into the building, I worked here for almost 20 years. By the way, I'm president, managing partner, CEO, and director of John Reed Stark Consulting, a company of just one. I have no stake in the crypto world or cryptoverse of any kind at all. I'm pretty much, you know, semi-retired. You can tell how calm I am. Yeah, I think that, so I look at this stuff very objectively, and I think back at the 20 years that I was here. I was 11 years, I was chief of the Office of Internet Enforcement. And it's tough coming in this building today because I hadn't been here for 15 years. And my first day was September 9th, 1991. And I met a guy, Mark Lewis, who would become one of my best friends in the world for 35 years. How many best friends do you have for 35 years? You know, I have some for 50 years, but Mark is very special. And
is he your boyfriend?
I've been thinking a lot about Mark lately because he's very sick with leukemia in New York.
That's not
why am I bringing that up today? First of all, everybody please hope for him. Second of all, Mark at the time wrote an article with then director Bill McLucas because someone had created a shadow SEC and said the SEC was overreaching with all of its regulations about things like insider trading and going off the rails and rogue in everything. And Mark and Bill McLucas wrote this, the director at the time wrote this article about principles-based regulation and the flexibility of 10b-5 and of things like Howey. And that design was specifically meant, as the Supreme Court has stated, not to cabin the scope of the definition of security. So when you look back at these transactions, these people are buying this because they're investors. And the SEC's, like I said, their mission is to protect investors. And I just don't see how you can, I appreciate the idea that you can say, okay, you know what, these laws can be done better. I remember Teresa Goody's old boss, Harvey Pitt, came in. One of the first cases that I worked on was an insider trading case involving an oil well. And he came in and he said, you know, there's no definition of insider trading and there's no breach of fiduciary duty here. And my client you should leave my client alone. And he was right. You know, when we looked at it, he was right. At the time, insider trading hadn't developed to that. But it didn't mean that, you know, if we recommended that there be a new definition of insider trading, that we stop all prosecution of it, or that we give up prosecution of it. You know, what it meant is, okay, maybe there can be better definition. When I worked under Commissioner Paredes at the time, there was a case called Doroshko, which involved somebody hacking into a system of a company and then trading on that system. That's what Doroshko did. He made like $5 or $10 million doing it. So we charged him. Sounds like insider trading, right? Well, the district court judge in that case said, nope, that's not insider trading. That's computer theft. And I remember I was joking with Commissioner Paredes, who called me into his office at that time, and he said, you got to stop with these cases because a district court has said that, number one, that there's no duty here. There should be a duty lurking, and this is not what insider trading is all about. And I understood that, and we stopped working on those cases. We appealed the 𝐂𝐨𝐻 case, which got overturned. It was sent back because the idea was, well, maybe this hack was a deception because whoever was hacking in there had somehow masqueraded themselves as an administrator, and that was a fraud, as opposed to, it's like dressing up like a letter carrier to steal inside information. That's a fraud. That's insider trading. That's SEC jurisdiction. But if you bang on the window and you walk in, not so much, and just steal the information. So the idea was, so then they came back and it turned out the EDGAR system got hacked and somebody was trading on information that they had gotten from people who had done EDGAR files. So the SEC ended up bringing one of the biggest cases ever. The only case they brought during the big shutdown was against the hackers who did that. So I get it that you can have some district courts that say one thing or the other, but right now we have many, many courts. It's unbelievable, really, the volume of case law that has developed so quickly because all of these crypto firms, they went for this sort of delay idea, and they hired the best law firms in the world. And these law firms all fought the SEC with incredible briefs, just incredible briefs. I've read every single one of them. And they lost just about, I would argue, every single time. Digital assets were securities, SAFs were securities, initial coin offerings were securities, staking products were securities, lending products were securities, all because of Howey. How can the SEC just suddenly say, you know what, the Division of Corporation Finance has decided that digital assets are not securities? I mean, there are some members of the states in the audience here, and I'm sure they're saying, well, not in my office, they're not. The SEC does not have this sort of unilateral authority. So I look, Commissioner Paredes, I look at it like, it's hard for me to call him Troy because, again, when I worked for him, he was always commissioner. But I look at it like this law has been decided and it's out there, and the SEC can't abdicate its responsibility, its mission to enforce those laws. They certainly can get together like this task force with all these brilliant people whose hearts are in the right place and say, this is different, here's what we think Congress should do. But they can't unilaterally repeal the 33 and the 34 Act because of this innovation. And I don't see it as innovation. I see the iPhone as innovation. I see the cloud as innovation. I see AI as innovation. I don't see it. I agree with Commissioner Crenshaw that the risks are tremendous and it just doesn't outweigh the benefits. Where's the utility? If it all went away tomorrow and you weren't speculating in it, you wouldn't care.
He almost said.
So that's sort of how I look at it.
This guy is in fact getting paid by
Miles,
the word. He just made
turning
a big
to you.
sack.
So I think John's perspective, principles-based, and that essentially the courts have addressed it. And so, Miles, from your perspective and the perspective of 𝐂𝐡𝐚𝐫𝐭 where your crypto, where you're the general counsel, what's your view in terms of not only principles-based, but in terms of the courts have spoken to it, and how does that perspective reconcile or not, as the case may be, with something that you and your firm have talked a lot about, which is decentralization in the context of crypto assets?
I like the argument.
So I think I'll start out by saying I agree that principles-based regulation is the proper approach, and I'm in alignment with John on that fact. I think from there, though, we start to depart quite a bit. I think it's a straw man argument to say that the people up here on this panel generally don't believe in principles-based regulation and that people are looking to apply formalistic restraints to Howey that would then allow for easy circumvention. I think that there are very few proposals that actually pursue, doing away with principles-based regulation. And I think that is for good reason, right? Most of us that work in the space understand that the nature of digital assets can change. What the underlying network that they relate to can be controlled by a single individual, or it can be controlled by no one and be completely autonomous. And so all of those things change the overall risk profile of it. As a result of that, I think a lot of us believe that principles-based regulation should continue to be the law of the land. The problem with principles-based regulation, though, is, as we've seen, I don't think that anyone could credibly argue that the last administration's approach to the industry accomplished any of the SEC's objectives. It did not lead to investor protection, it did not lead to capital formation, and it did not lead to efficient markets. As a result of that, the current approach is clearly a failure, and we have to do better. Now, some people will argue that means getting rid of principles-based regulation.
𝐂𝐡𝐚𝐫𝐭 Is this it? Is it just on Uniswap? That seems very weird. Is this guy really sitting in front of a sign that says General Counsel 𝐂𝐡𝐚𝐫𝐭 and that's the chart? What?
Applying formalistic requirements to Howey to say, hey, if you don't have a legal relationship with the issuer, then securities laws shouldn't apply. I firmly do not believe that that is the case. That would allow for very easy circumvention, and such an approach would make it impossible to distinguish Bitcoin from, an asset like FTT, which was basically a profits interest in FTX, where FTX promised the market that they would buy back the token with their profits from running their exchange. Right? And there was no legal relationship with people that were investing in that token, but clearly the economic reality of those transactions were that people were investing in a proxy into FTX. Pretty good sign of that being a securities transaction was that when FTX shut down, that asset went to zero, right? We do not believe that type of thing should escape the bounds of securities laws, nor do we think that you should be able to escape securities laws merely by providing some additional disclosure on it. We don't exclude brokers, we don't exclude exchanges, we don't exclude notes from being securities simply because there's disclosure provided around them, nor should we do so with investment contracts. But fundamentally, right, if we look at the SEC's approach, if we want to embrace the idea that we're going to do and look at substance over form, right, and we're going to focus on the substance, we have to engage with what that substance actually is, and we have to do the work of defining what that substance is. That does not mean, right, continuing to not provide any guidance to the industry, right, letting the courts decide over a period of years, right, what happens, having decisions that are at odds with one another. Yes, the SEC has won some cases. They have not won a single case that applies Howey to secondary transactions. They've only won on motions to dismiss, so it was kind of a miscategorization to speak about the cases that way. And on top of all of that, right, we have entrepreneurs everywhere, right, that are looking to do the right thing, and what they're faced with every day as a result of this regulatory uncertainty is bad actors taking advantage of the regulatory uncertainty to push to the limits of where securities laws potentially apply, right? Deliberately going over that line, hoping that they don't get caught. Meanwhile, the good entrepreneurs are sitting there talking to us saying, hey, why can't I do what X is doing? Well, because government inaction is not consent. That is a very hard conversation to have with entrepreneurs, and it's one that I have every single day. We are not fostering innovation. We're not protecting investors. We're not helping capital formation. So we have to engage with the substance. Our general approach and the way that we believe that the SEC should focus on the issue is to look at control. That is a technology-neutral, merit-neutral approach to looking at what differentiates a system like Ethereum from ownership of equity in Apple, right? Apple is a system that is controlled by humans. Ethereum is not controlled by humans. As a result of that, the risk profile of that underlying asset, the trust dependencies associated with that asset are very different. Teresa talked about a second ago, right? She said that one of the things that C-Corps did was it allowed us to split ownership from control, right? That's a very important concept, right? Shareholders don't have direct control. They use officers and directors as their proxy. Blockchain systems, right, can have ownership without any control whatsoever. They can function autonomously, permissionlessly, trustlessly. As a result of that, the inherent trust dependencies that come up with a share of stock are not relevant for certain crypto assets that meet, control criteria. As a result of that, we do not think, right, in those cases that securities laws should apply the same way they apply to shares of equity.
Great, thanks, Miles.
Okay. You actually made some sense there.
Collins. We've heard a lot of different views. I think some instances where there's some degree of overlap and complementarity, even if there's a point at which there's some departure. Some is a different way to frame, but not necessarily an inconsistent way to frame. Others who think, the courts have taken care of it. Others say, well, maybe they've taken care of it, but there's still confusion and a lack of clarity. And so how does that factor in, setting aside jurisprudence, set aside the role of the courts? How does that impact clarity in terms of a very practical matter? So all these different perspectives and viewpoints so far. So from your perspective, as somebody who is advising early stage companies, and again, that picking up on a point that Miles was referring to, you got to give advice, you got to give counsel, you want folks to do things the right way. Of course, you have entrepreneurs who have really cool, interesting things to do. How do you counsel and advise, not in the context of a particular client, of course, but just as a general matter, how do you approach that? And is there a particular something that you think would be the most constructive thing the SEC could do or reconsider or double down on
People
in
look so
order
bored.
to try to achieve whatever you happen to think ought to be achieved here in this context?
Yeah, thanks. So I think kind of as a preliminary matter, one of the things that this conversation might reveal is that one of the first things I'm always talking about is whether we're in a capital formation context or some other context. And I think we beg the question a little bit when we start only focusing on capital formation, because to be frank, it's obviously a very significant part of the industry, but there are so many other elements of the industry that are affected by this downstream taxonomical question that get lost in this discussion, and that's often what I'm frequently dealing with my entrepreneurs on. So I represent a lot of people that are in the decentralized finance industry, and so the threshold question of what an asset isn't just relevant for capital formation in a couple of ways, and I'll give a few examples. When you're dealing with somebody who does something like a DeFi front end, and this is a type of application or a website that provides access to an underlying protocol, there's a question first off as to whether they are providing access to that service directly or if they're acting as a mere conduit. And this is relevant because when you're looking at whether you've got this taxonomy of do you have a security or not, there's a question of, okay, well, if this thing is a security, and I am actually acting in a capacity beyond just being a conduit, I may be stepping into the broker-dealer world. If it's not, I may be in some other type of category. Another type of example is if I'm dealing with a type of security, but it's equity or debt, and I'm going to conduct a capital formation type of transaction, what type of regime am I dealing with if I'm in Reg S? Is it a Category 1, Category 2, Category 3 security? So I think those are just two quick examples, but one of the first things that I'm always thinking about is what's the context that I'm operating in? Am I thinking about capital formation? Am I thinking about something else? And are the issues going to be the same that way? And I think that's one of the kind of deficiencies in saying, oh, the courts have resolved this as kind of an aside, because even to the extent that we accept that every single one of these things are securities, and I don't accept that, but even if we were to accept that argument, there are so many downstream questions as a result of that that are left unanswered by courts right now, that acting as though we can just sit and say, all right, well, the courts have decided that some things are securities, we're done here, let's head back here in 20 years, is clearly insufficient. So that's one challenge. And when I'm talking to my founders, whether it's in the DeFi context, whether it's in capital formation, whether it's something else, all of those things are in mind. And I would say that generally speaking, while I've got some maybe gaps or maybe distinctions from where I'd say Miles' kind of theories land, I'm generally aligned with, I think, the notion of control being a central feature of our assessment. Now, I think, again, that's relevant for both an exemptive framework, but also taxonomy questions. And I think that's also something that we need to maybe delineate some as we get through this conversation, because some of us are talking about purely classifying assets as securities or non-securities. That's at the top of the funnel, although arguably the very top of the funnel is, do we have a securities transaction or do we have an exempt security? But once we get past that, then the next question is, do we have a security or a non-security? Those are top of the funnel, I guess, questions. But after that point, I don't think we've got, what's the right word here? I guess, I don't think we have the right substance to get to the sub-points of our assets. So for instance, in I believe Miles's comment that they submitted, they've got a proposal where you look at, once you're in the securities world, what type of asset might this thing be? Is it an asset-backed token? Is it a token with intrinsic securities, properties? Is it some other type of thing? Those things will probably all have relevance for the type of exemptive relief that may apply. It doesn't necessarily mean that all those things aren't securities, but it might mean that we may not need to have certain types of disclosures for certain assets that inherently provide information in the operation of their system relative to something like FTT, which I think they refer to as company-backed tokens, where it seems very clear to me that our traditional frameworks would apply. So I guess going to, I think your original question was, what do I think is important? I do think the element of control is important for exemptive frameworks. It's probably important for taxonomy questions, but I think first getting through one, delineating transactions versus securities, getting a framework for just easily establishing a security bucket versus a non-security bucket, and then looking within that security bucket and saying, okay, if we're going to have exemptive frameworks, does something like Reg D work for these types of things? I posit that it doesn't. Something like, Commissioner Purse's 195 framework or some of the other people's frameworks up here probably surface more relevant information than our current exemptive frameworks. And so I go back to kind of my point earlier. I think it's hard to say right now, even if we all accepted that every single thing was security, we'd still be doing the public a good service by saying the current framework works fine.
And so, Collins, I take the point there, and feel free to correct me if I summarize at a high level incorrectly, and then Ben, I'm going to come to you, being in no small part that, yes, the discussion of is something a security or not, but that, as you said, that's top of the funnel, that even as to whatever ends up being put into the security bucket, that there are nuances and distinctions within that bucket that then has other effects that one would need to take into account, so that the security, not security, important, but there are subtleties to that, particularly when you get to other topics that the task force will be taking up, which is more about how you substantively regulate. Well, that's not the topic today. The classification and the disaggregation of the entirety of the is it a security, yes bucket, that disaggregation, classification, nuance, not all assets in that bucket are the same as all other assets, you think proves to be important when it comes to the substantive regulation that they'll get to down the road?
Yeah, I think I'd say it's probably critical, to be honest. I mean, I think today if we solve the problem of like, hey, what's a security and what's a non-security, so many questions, like Rule 12G, for instance, like, can I have 2,000 holders of a token or not? Well, that's going to depend on what it's a security. Is it an equity or is it a debt security? That's not resolved by somebody telling me today that like the thing is a security. So yeah, I think it's absolutely critical.
Great. Ben, you two have a unique perspective. You were at the commission for a long time. Now you're at a firm that focuses on policy, where you're focusing on policy. So given that, I wanted to focus with you on, and in some sense it goes back to what Chris was saying, but I think there's a current of it across the comments, including what John was saying, which is that one can take a step back and think about what are the overall driving policy considerations that inform the federal securities laws as they have long existed. And then when one identifies those policy considerations, how does that inform? One doesn't want to overstate, but I think the point is how does that then inform how you think about the threshold question, whether something is or isn't a security, or the type of security it is, even if it is a security. So as you've approached it, how does policy generally, but the policy that motivates the federal securities laws, inform that assessment as to whether or not something is or isn't a security, given what the objective of the federal securities laws are to begin with?
Thanks very much, and let me thank the SEC and the Crypto Task Force for this event and for having me. I want to echo what John said about Commissioner Purse. It's been a privilege to work with her in the past, and I have nothing but the highest respect for her and the work that she does. As to the question, I think the policy is so fundamental to this question, because I think what has to underlie every policy decision that the SEC makes is the SEC's mission. And I totally believe in the three-part mission. I believe capital formation is important. I believe fair and efficient markets are important, but I also believe investor protection is very, very important. And so when you're thinking about the question of what is a security, I think you have to think about, well, how can you best protect investors? And so I think about it from the perspective of investors, and I agree with what John said, that from my perspective, investors are purchasing crypto assets as an investment. And I think that, that should inform the question. I think if investors are being marketed these assets as an investment, being told, hey, if you buy this, if you give us your money, we'll do things with the money, and then you can profit from it, that seems like a security. And I think that has to inform the discussion. I went yesterday to look at the websites of some large broker-dealers, and on the webpage of a lot of them, not all of them, but a lot of them, there's always a tab about products that they offer. And In a lot of cases, they say stocks, bonds, mutual funds, ETFs, crypto. I struggle with the idea that only 4 out of 5 are securities and not all 5. But even if you disagree, I worry that investors would be confused, right? Can it really be the case that they're going to understand, even if you envision a world where all crypto assets are deemed to not be securities, are they going to understand that, or are they going to not understand that and be put at risk as a result? And so I think that that question of how can you best protect investors and how are these products being marketed to investors is really fundamental.
Can I just jump in only because I've heard the Chris view just mentioned a couple of times. One of the occupational hazards of going first. I did want to just for clarity, when I was starting, and maybe this is helpful for the conversation or maybe it's not. Ultimately, the question was framed for, well, what do you sort of think about the optimal sort of elements of a crypto regime? And to reiterate what we've already heard, there are different objectives. There's investor protection, and capital formation is also very important. And by the way, capital formation itself creates all kinds of interesting questions as to the regulatory perimeter. But once you do fall in that perimeter, the commission does have plenty of rulemaking authority. It happens all the time. I mean, courts make decisions, commissions then go about and they craft rules in response. They have exemptive authority, even with regards to primary legislation. The risk element was, you have to have a starting point for saying, okay, well, why are we involved in the first place? And then you have to take the secondary step of identifying, well, what's the appropriate regulatory response? If there isn't any, and this is, I guess, to echoing different folks at different times, but caveat emptor is not a regulatory strategy, and that's what we've had, and then you end up, complicating efforts to both protect investors and also to promote capital formation, and that's a challenge. Now I said my piece. All right, thanks.
Yes, sir.
Great, thanks,
Did
Chris.
ya? I don't know if you did.
Rodrigo.
So
You've been at a fund, now you're practicing. From your perspective, having had the chance to hear what's been said, as well as just your experience, is there one thing in particular that you think the commission could or should do, or at least could or should consider doing?
Get him, Rodrigo. He's gonna say
Thank you, and
something
I'm
good.
Rodrigo Seda, Special Counsel at 𝐂𝐡𝐚𝐫𝐿.
I already like him.
So maybe I'll try to respond to some of the earlier comments and get to the conclusion of what I think they could do.
Good.
I think it's key first to understand that just because there's investment intent behind the purchase doesn't turn that transaction automatically into a security, right? I think that's a logical fallacy and something that would basically mean that securities law would eat the world and not one where I want to live in, right? So I think we have to be careful about the way that we shape this regime, understanding that we need to protect the capital markets and make sure that we don't create any loopholes, but also make sure that we're developing a framework that doesn't end up, again, consuming the world. I, for example, was talking yesterday over dinner about how I like to purchase art. Last week I was in New York. I purchased a piece from a young artist, partly because I liked it, I thought it was cool, but also it was somewhat of a bet that he would keep working, and he had a couple of shows lined up that I thought were interesting. I don't think that means that that transaction all of a sudden should be regulated as a securities transaction, right? I think I want to push back a little bit on this idea that the case law has been clear when applied to crypto, right? I think it's important to distinguish between the couple of waves of enforcement that the SEC brought. The first wave was really centered around ICOs and fraud. And it was mostly against defendants that didn't have the money or the incentive to fight a SEC enforcement. So a lot of those ended up in settlements, right? And I think from some of those we can take the premise that when you're selling crypto assets in a fundraising transaction, that fundraising transaction should be regulated by securities. And I think most of us on this panel would agree on that, right? I think the second wave of enforcement that focused more on intermediaries and brought pure registration violations And it also targeted as defendants companies that had the resources and incentive to like fight a bet the company litigation, like resulted in a much more mixed bag of results, right? I don't think the SEC itself was clear in those cases about what it actually considered to be a security. The judge in the Binance opinion kind of chastised the staff about this, where they had flip-flopped between what exactly was the investment contract. And then I think we can't look over the fact that there was a split even in the same district court over whether how we extended to secondary transactions when you look at Ripple and you look at
If we
the
could
Harris
just,
opinion.
if we could just not talk about any specific cases, that'd be great.
Sorry, apologies for that. Anyways, I don't think it's
No.
I don't think it's true to say that the law is clear. And from the practitioner's perspective, I can tell you that I don't know what the law is. Like, you have to somewhat try to advise people from general principles here, right?
Oh my God, don't talk about
I think it's
oh my
also
God.
important to understand that the current regulatory framework, the securities regulatory framework that is premised on registration and disclosure, is not fit for purpose for all crypto instruments. Well, it might apply for fundraising transactions. I think if we just fit crypto, if we jam it into securities, we're going to end up deprecating a lot of its unique qualities, right? Crypto, at least for me, the reason I got into this space was because I saw it as a technology that enabled a new form of human collaboration, right? It allows people to come together in a digitally native way and collaborate over open source and public goods in a way that wasn't possible before. And it gives people technological rights within a system that I think are, or I guess I should say technological powers within a system that I think are different from legal rights. So I don't think that just forcing the registration and disclosure regime onto these systems is going to really address the policy goals. And if you follow the downstream effects of doing that, I think it actually really handicaps the development of crypto in the United States. Yeah, and I guess finally, to kind of respond to the idea that the SEC has predetermined that certain actions or certain tokens are not securities, or they've there's some whiplash here. I think to me that is an attempt to regulate with humility and a sense of responsibility that is very important, and it comes from the premise of we're all here with varying points of disagreement. It's required of a regulator when they're doing their job to, I think, first clarify these points of disagreements before you take somebody to court and try to figure it out there, right? So I actually commend the SEC on their new approach of engaging with industry, and I think, frankly, needs to be a lot of work done to rebuild those channels of communication and trust between industry and regulators that I think are ultimately going to leave everybody off in a better place.
Great.
Yeah.
Thank you, Rodrigo.
Hold this up really quick. Anybody joining, this is the SEC's Roundtable on Crypto Regulation. And you have really not missed much. If you're just tuning in now, you're really just as well off as the rest of us. There's been a wide range of speakers, different knowledges, I think different backgrounds when it comes to law, security, whatever. I'm not sure if they're unwilling to say anything significant or if maybe that isn't the point of this roundtable. It's kind of hard to tell, honestly, what the point is of this roundtable. You guys in chat, put out your guesses, put out your answers if you know, or if you've kind of read between the lines here. But something I'm picking up is none of these people are, they're not in the SEC. These are all, if you look at their name cards, you look at their titles, they're just CEOs of venture capital or I don't know, different kind of semi-crypto stuff. None of them are in the SEC, yet this is the SEC's roundtable for crypto regulation. It's kind of weird. It's a little weird. But really what we're getting is just kind of these people's thoughts on should crypto be a security, or should some, or should all of them, or none of them, etc. And some people have weighed in with some interesting stuff. So I'll put it back up.
So Lewis, so you've written a lot on Howey.
One last thing, guys, make sure you're smashing that like button and subscribing if you're liking the content. We covered the FOMC on Wednesday. Today, surprise, we're covering this. Join our fam.
As applied to crypto. And as I understand it, one of the distinctions you've drawn often in your writing is an investment contract, if it exists, from the token or a token or a crypto asset. Can you explain more conceptually that distinction? And beyond conceptually that distinction, practically, how does one identify when that distinction actually exists?
Sure. Thank you, Troy, and thank you, Commissioner Peirce. To figure out, hey, am I engaged in a securities transaction or am I not? If you could simply look at a token and say, oh, I see, there you go, that would be one thing. But if we create a construct in which every time any market participant needs to decide, am I engaged in a regulated activity, they have to make a time-consuming and expensive conclusion, then that really is very, very problematic from a market efficiency point of view. So the distinction is, when do I have something that is an instrument that no matter how it is dealt with, and I think Collins, I'm glad you brought up Section 12G because it's a good example. You have to know, is this something that's going to trigger 12G? As a broker-dealer, am I custodying a security or customer funds, or am I not? There are many places where you need to know, is this thing sitting there by itself a security or not? And that's an important distinction that our securities laws need to recognize. Now, maybe we'll be better off with something that Congress decides, here's a new framework, and here's how you think about crypto assets in the round, whether or not they're securities. And I think something could be said for that. But for right now, at least, we need to be able to make those distinctions so that market participants know when they're dealing with it. The people selling and fundraising, in most cases, can figure this out. And they're the ones that, in my view, should have that duty to figure out. They also have disclosure obligations. I think really, Troy, that what has been the greatest point of consternation here is because there hasn't been a pathway to properly sell these assets to the public, what we have are assets being sold in private transactions with little or no disclosure and then publicly traded, and a real absence of what the securities laws really are trying to address. And personally, I hope we can find a way out of that that problem.
Sure.
Just to add, and I won't say I necessarily disagree with Lewis in the sense that I'm not sure, maybe if everybody's read his paper, there's maybe a sense that there should be a potential blanket, let's say, exclusion on secondary transactions. I don't take a position on that, but I do think historically our laws, and both the federal and state laws, have taken a position as to delineating the securities and the transaction itself. I think obviously we have Section 3 exempt securities and then Section 4 exempt transactions at the federal level. But then at every single state level, I think somebody said there are state regulators here, so they can obviously confirm. But at every single state level, we distinguish between exempt securities, usually in the prior section, and the transaction itself. So I think the past century of both legislative and rulemaking and jurisprudence does acknowledge that there are times where the transaction itself is obviously the focus of our inquiry, and then there are times that the asset itself is the focus of our inquiry. Sometimes those things may be one and the same. I think in particular for crypto, it's probably difficult to get to a place, at least from my end, where every single crypto asset would not be a security if it was only in a secondary transaction. And at the same time, there are probably some crypto assets that even if they weren't sold in exempt transactions, would inherently have properties that would make them securities. But I think that distinction should definitely not be one that seems to be somewhat controversial in some circles, because we've had that framework for almost a century now. So.
Great, Collins. Thank you.
𝐂𝐡 says tornado cash is legal. It's used in the U.S. now. Says
Moving on to you, and then that's going to leave
Interesting.
𝐂𝐲, and then we're going to get more interaction among all of you. But Lee, what's your take? My sense is that your view, and again, correct me if I'm wrong as I try to summarize, is that the question has, to some extent, as to what's a security in the context of crypto, maybe more than just to some extent, has been asked and answered by the Supreme Court and by the courts over the years. Is that a fair summation? And how do you think about the following aspect of it, going back to various things we've heard, which is you take the four prongs of Howey, for example, or even a principles-based approach. There's still then the practical question as to, but how does it get applied to any specific set of facts and circumstances? So that kind of translation of a 4-part test or set of principles to actually being applied to concrete real-world facts and circumstances and some of the tough judgment calls. How does consideration of that, if it does, factor in terms of your take as to what constitutes a security when it comes to crypto, and if there's anything for the Commission to do to provide additional clarity or to rethink the approach?
Sure. Thank you, Troy, and thank you, Commissioner Peirce, for hosting us and the staff for putting this together. I know from experience that events like this take a lot of effort, so certainly appreciate it. So I'm Lee Reiners. I'm from Duke University, and let the record show that we tipped off about 10 minutes ago. So go Duke. Let me also note that there's quite a bit of distance here between my fellow crypto skeptics, so feeling a little isolated up here. But let me just start off with a note of agreement on some of the things we've discussed. And obviously, we're here to start with, as we said, the top of the funnel. When is a crypto asset a security or not? But then I think, sort of once that is decided, and I think it's pretty clear, and I agree with John that courts, not just in SEC enforcement cases, but in private litigation, and state enforcement actions. And let's not forget, the states have been the earliest on the scene when it comes to crypto. But after that, I think it is pretty clear, in my opinion at least, that some of the existing rules are not necessarily fit for purpose, and I think disclosure is exactly one of them. I don't think it's controversial to suggest that the information an investor in a crypto asset would want is just fundamentally different than the information an investor in Apple stock would want. I don't see how that's controversial, and obviously there's been custom disclosure frameworks provided in other contexts, asset-backed securities, and so this is something that Chair 𝐂𝐴𝐺 has suggested, and I would certainly be open to. Another issue, of course, is, well, should a broker-dealer be able to offer securities alongside crypto assets that are probably commodities, right? And I frankly don't see the issue with that, provided certain risk controls are in place, and that's perhaps an opportunity for the Commission to use its exemptive authority, as others have suggested. So I put all that out there to know that I am not necessarily disagreeing with my fellow panelists on every single issue, but look, the Howey test is a flexible standard, and I have to disagree with Rodrigo's disagreement with John, and in over hundreds of cases, right? Judges have applied Howey's 3 or 4 prongs, depending on your perspective, to the offering of digital asset transactions, and found, in fact, there was a presence of an investment contract. I think, look, one issue that Lewis raised, and I put in my statement, is this notion of what I call the separation theory, and as Lewis pointed out earlier, perhaps I should have called it the embodiment theory, and this was raised in a ruling that Rodrigo referenced, but I will not reference it because I will follow the rules.
Don't you say XRP.
In which case, sorry to throw in his Rodrigo. In which a judge, pointed out that the subject of an investment contract is separate or different from the investment contract itself, right? So, Citrus Groves itself were not an investment contract, right? But when packaged with Howey's promise to manage those and distribute profits, then the whole sort of scheme became an investment contract. And so I kind of grappled with this in my statement. And where I came out with is that there's a fundamental difference here between the subject of a security scheme and the security instrument itself, and that difference is the means of participation. So no one received Howey's promise earnings distributions by simply buying the orange groves, right? On the contrary, a token issuer promises profits by impacting the price of the token. Therefore, all the purchasers of the token receive profit through the issuer's efforts. And because tokens are fungible, it's impossible for the issuer's promise of profits to be paired with some tokens and not all tokens. So whereas the fortunes of 99.99% of Orange Grove owners have no relation at all to Howey, the fortunes of all token holders are dependent on the token issuer. So therefore, I think it's pretty clear the token is not merely the subject of the scheme. It is the security instrument itself, and I think if some of these cases been allowed to proceed, I think that's certainly where courts would have come out. So again, I think, how he's flexible, it's facts and circumstances dependent. Another thing that's sort of come up is sort of the role of decentralization. We would probably all agree, I'm guessing, that Bitcoin is not a security, is not an investment contract because it is sufficiently decentralized. There are no, there's no common enterprise. There's no others to point to receive your expected profit. So of course that raises the question then is, can we draw a line where something is sufficiently decentralized to no longer be considered an investment contract? And I just think that's an impossible line to draw. And I would point folks to the CFTC's report that came out in 2014, or 2024, I'm sorry, is a report from the Technology Advisory Committee on DeFi. And the members of this committee that put together that report were mostly worked in the crypto industry, including at DeFi firms. And they noted that decentralization exists along a spectrum across multiple dimensions. So you have governance, asset, user, application, data, network, protocol, hardware. So how do you determine when these dimensions are sufficiently decentralized enough to ensure profits don't come from the efforts of others? I just think, again, that is a completely futile task for any agency to try to attempt. Even if you do attempt it and you suggest, okay, we think in these conditions it's not an investment contract, it's not a security, well then it may be a commodity, and you might have the CFTC making a ruling that you don't necessarily agree with, right? So finding that DAO governance token holders who vote their governance tokens can be held jointly and severally liable for the actions of the DAO. And so this is why I think it's best to just leave it to the courts and have it be facts and circumstances dependent, because otherwise you're just never going to get to, I know we all want to get to this sort of promised land of clarity, and I just, again, I don't think you'll be able to do it. And my final point is, look, whatever outcome of this task force, and perhaps there's sort of a new guidance in terms of how the SEC is going to apply or interpret Howey to digital assets going forward, that doesn't mean that courts have to follow it, right? And to the extent the SEC is no longer going to be an effective cop on the beat when it comes to crypto, that void is going to be filled by private plaintiffs, okay, who are going to perhaps have a different interpretation of Howey. And in fact, we have seen numerous cases in which courts have agreed with plaintiffs across, not just digital assets, ICOs, but even NFTs, that they were found to meet the definition of an investment contract. States are not going to stop either. So while the purpose and intent may be to provide regulatory clarity, the effect may actually end up being the opposite. And that was, I just want to end on that sort of note of caution to those who are doing this great work.
Every time
Great,
they say NFT.
Thanks, Lee. And then 𝐂𝐲, to you. So
Best for last.
yeah, and then if there's stuff folks want to react to, reply to, try to get my attention, Teresa already has, and I got a question or two ready to go, which I may get to before Teresa I get to you, just because I think there's a topic that I haven't heard mentioned that I want to make sure we come back to, and I'll let whoever wants to respond. But first, 𝐂𝐲, we've heard a lot of different perspectives, including the perspective that Lee just mentioned, which is, if it were, as I understand it, and Lee, again, correct me if I get this wrong, if it were to be the case that the SEC were to be perceived to be scaling back its role from an enforcement perspective, that others may see that as occasion and or opportunity and or reason to fill that void in some way or another, which may then beg the question as to, on a net basis, where did things come out from a clarity perspective or otherwise, which speaks to a general point, which is things are dynamic, right? That if this changes, other things change in reaction, other things change in reaction, and so how does the whole system come to rest in terms of some equilibrium? That's much more complicated than a more static analysis where one presumes everything is the same other than the one thing that changes. I think Lee gets to kind of at a bigger picture level the point that you're making, if I, again, understand it correctly. So, 𝐂𝐲, from your perspective as somebody who's practicing in the area presently, and you think about those kinds of dynamics, you think about the fact that there is a lot of jurisprudence on the books for a lot of decades now, as Lewis mentioned, having read all the cases, you also think about the reality that applying, I think, anything that's a set of factors or considerations or principles to, real facts and circumstances, there are judgment calls to be made in terms of how to proceed and what regulations apply, what regulatory bodies have jurisdiction or not. So in light of all of that, where do you stand on these questions? And again, come back to a common question I've asked a few folks. Is there a particular something that you think the commission should or could either do or consider that would make a big difference?
Should or could or.
Yeah, thank you, and thank you, Commissioner Peirce, and to the task force for having me. I think Rodrigo used a term that I really want to zero in on because I think it's directly responsive and maybe colors all of my comments. The term of regulatory humility, right? Lee, you're absolutely right. The SEC is not the only player here. You're going to have private litigation, but the other big issue that's going on right now is Congress is actively considering legislation that would assign spot market trading oversight to potentially the SEC and CFTC, or potentially just to the CFTC, right? So, these academic arguments are important and good, but at the end of the day, Congress is actively looking at this, and while they won't provide clarity on every single thing, they may provide clarity to the SEC and limit what it can do in this space. With that in mind, we've had a lot of discussion about are these assets securities or not? And I think that's a little misleading. I think of the assets in the context of a transaction, right? Like I understand we're talking about policy too, but the SEC has to keep themselves limited to the legal analysis. So you have to start at the statute. Teresa mentioned all the different instruments that count as a security. If you don't fit as an equity, you don't fit as a debt, you don't fit as a certificate of interest, all these things, the only thing you have left is an investment contract. So for most crypto assets, we're talking about investment contracts. That requires a contract, a transaction, or a scheme. So we're talking about transactions, right? And notwithstanding Lee's arguments about the embodiment theory, to date, no court has agreed to that. And it's a point I certainly see the argument. But there is no regulatory pathway for an embodied investment contract to have a secondary market at the SEC. It's just something the SEC has never contemplated before. It's just not a real legitimate pathway forward. So I think from the SEC's perspective, in limiting themselves into transactions and thinking of how they can provide clarity, keeping in mind the humility that Congress is looking at this space, it's starting from a principled theory of what 𝐂𝐻 covers, what types of transactions it covers, and what it doesn't. And so I think as they've already started to do, and I applaud the work with the meme coin statement and the mining statement that came out of proof of work mining, is identify just certain transactions that you are comfortable fall outside of the securities laws. Or conversely, if there's a problem, if you think there's certain risks that certain transactions do fall within the securities laws, well, soliciting public input on that would be really helpful and useful, right? So I think, certain things that just happen, staking as a service, airdrops, stable coins, things like that, just basic transactions, secondary market transactions. I know there's ongoing litigation that we can't talk about. These are things that the SEC, I hope the task force will be able to look at and start carving out and carving in. Maybe the other important point that I just want to drive home here is that this is not happening in a vacuum. All of the activity that is ongoing is going on right now outside of the securities laws, with some notable exceptions, obviously, of folks that are fundraising pursuant to Reg D and the like. So if the SEC is going to inject itself into different transactions that has not injected itself yet, I think it better to have a couple things in mind. One, it should obviously have a sound legal argument of why this is a transaction that is subject to the securities laws. Two, it should have a clear policy goal of what it's trying to achieve, who it's trying to protect, and why. And three, without even knowing the transaction, I can guarantee you there's not a pathway currently at the SEC for that to be achieved in an efficient manner. So I encourage that in the same breath, the thought of if something is within the securities laws, the immediate conversation needs to pivot to how can compliance with the securities laws be met? And a more proactive agency from what we've seen in recent years would be very welcome, and I'm super encouraged by the efforts so far. I'm grateful that you're doing the work that you're doing.
Great, thanks, 𝐂𝐻. I know Teresa has some thoughts that she got my attention on. Does anybody else maybe everybody, but Teresa, John, Collins, anybody else? Lewis. I'm going to do my best here. Anybody else? Let's see, Miles. I think I'll just go through the list here, it just looks like. So I thought might be the case. Anybody else? Anybody else? Yeah, okay, Ben. All right, if I miss you, and if there is anybody else as we get through, just chime in. So maybe in that case, I'm just going to go back through, or I'm going to bounce around a little bit and exercise some moderators' prerogative here. But there is a question, and I'm going to ask everybody to be brief in their kind of next comments, but also in response to the following, and maybe somebody just get my attention if they want to take this up. One of the things that I didn't hear mentioned, and I may have just missed it, is express discussion about use and consumption as compared to investment. So you think about United Housing versus Foreman, which is a really important part of the jurisprudence, as well as market forces versus efforts of others if you're looking at it from a Howey perspective. Right? There's a lot of things that can influence a price, but that doesn't necessarily mean, according to the courts, that it's the kind of efforts of others that would satisfy that particular prong of Howey. And there's case law, not a ton, but there's case law to that extent. And again, use consumption, you think about in the context of Howey itself, to twist the facts to what they weren't, but just to illustrate the point, if in Howey it had been the case, it was not the case, but if it had been the case that the individuals involved could have come into the groves, picked some oranges, eaten some of them, given some away, maybe set up an orange stand, maybe went to a farmer's market, that case very likely would have turned out differently, or at least there was the prospect that that case would have turned out differently. And I think there's really, you see that in United Housing versus Foreman in terms of use consumption as juxtaposed to investment. And then there's another layer to it, which is speculation the same as investment? I think some folks talked about that to suggest that speculation is not the same as investment, that there's a lot of things people speculate on hoping that it becomes more valuable that folks wouldn't think of as being a security. So if you take those points, which I think hover around a lot of the discussions over the years as to what is or is not a security, in particular, the use, consumption, United Housing versus Foreman, and if market forces are the thing that are determining the price as compared to meaningful efforts or managerial and entrepreneurial efforts of others. Anybody want to offer a perspective or two? Miles?
Yeah, so I mean, I think that the SEC actually got this right back in 2017 and 2018 when, they basically said that the presence of utility is not enough to exclude an asset from the securities laws regimes. I think everyone would agree here that if Amazon started accepting Amazon stock to pay for AWS services, we wouldn't exempt Amazon stock from securities laws, and I don't think that we should do the same with digital assets. It's undeniable that there are people that are investing in digital assets. It's undeniable that some of those have use cases. But trying to grade the line between where there's more consumptive intent than investment intent, I think is even more impossible than defining sufficient decentralization. So as a result of that, I think that's kind of a bridge to nowhere. I think it's easier to focus on the efforts of others and where the value is being derived from a given asset. Again, going back to my example earlier, with Ethereum, there is a financial interest in the operation of the network. That network functions without human intervention and control. It's fully autonomous and permissionless. No company going away could harm the economic value of that asset. Compare that to a share of Apple stock or FTT, right, where the clear economic value was derived from the profits of an enterprise that were then being deployed back into that asset. And so I think, again, the efforts of others, I think, has been in the 2019 framework that the SEC put out was used in a very expansive way, 40 different factors of very subjective nature, which has been very difficult to enforce. And I think that if we can constrain it to a more objective perspective, one that's focused on control, it's a lot easier to define what decentralization is and what may de-risk an asset and therefore justify not applying securities laws.
Good, thanks, Miles. Sarah?
Just as a small point, right, I think there's two extremes here of one, your asset got infected by a securities transaction and is a security forever. And on the other end, there's sort of people arguing for more of a four corners test. is based on the intrinsic characteristics of this asset, we wouldn't consider it a security. But the thing about tokens is they aren't oranges. Like, while the issuer or the initial development group retains control over all aspects of the network, the DApp, the token, they can inherently change the functionality of the token. The token is whatever they want it to be, today or tomorrow. And so that won't give us certainty. And so that's why I do agree with Miles that there's this inflection point where they no longer can control those characteristics, and then it is de-risked.
Chris?
Yeah, I just like to, I'm pretty, I guess, sympathetic to a kind of control standard. I mean, insofar as it's not foreign to securities law in any way, right? I mean, when you think about, definitions of what constitutes a distribution, or when you think about minority shareholders and their rights towards others, that's certainly cleaner than utility. And yes, so the Supreme Court on various occasions has tried to sort of draw that line between the two. Maybe since we were asked to give each other questions, you have any suggestions in terms of how you would actually implement this? Is there like a percentage number that you have in mind in terms of control of network or
well, I think it's very important when we talk about control, right, that we're not talking about just the disbursement of control. So while I think that there is some importance in looking at thresholds, right, I don't think if you were to just solely say, hey, look, if everyone owns 1% of this network, then it's not controlled and therefore we don't apply securities laws. I don't believe that that's correct. I believe that partnership interests can be securities. Partnerships can be very decentralized. Right, but the difference between an ordinary partnership that might be decentralized and a blockchain network, right, is that you can eliminate mechanisms of control, right? You can make it impossible for anyone to actually change the system and thereby influence control. And where you have that, right, you eliminate the ability of anyone to unilaterally affect or structure the risk of the underlying asset, right, and affect the probabilistic outcomes associated with that asset. And as a result of that, so if you look at things like autonomy, permissionlessness, right, all of these things that transform, blockchain networks from being proprietary software like Apple's App Store into things that function more like public infrastructure that no one controls, I think that's really the core criteria. So I think, voting rights, voting power is part of that, but I think it's only one part.
So just to clarify, Mo, so control means that you could modify the code, and if no one can modify the code, there's no control?
I think the mechanism for modifying the control is certainly a worthy kind of criteria. But for instance, there are systems where no person can modify the code whatsoever. Uniswap is a smart contract protocol that has smart contracts deployed, which is programmable, executable software deployed to a blockchain, right, that are completely immutable. No one can change how they function. As a result, no one can change the economic value of those smart contracts or the economic value of the token that relates to those smart contracts.
But what if an entity can just release an updated version of the protocol that's not the same as the previous protocol, but that's where people migrate to?
Well, so what the critical criteria there is, you're absolutely right. Someone could deploy Uniswap version 20 tomorrow, right? But where do the network effects of the system accrue? Right, and that's what the key economic kind of decision or analysis relates to. Network effects in a system like Uniswap and a system like Ethereum accrue to the network. Therefore, they accrue to the token holders. If someone tomorrow was to say, hey, we're going to deploy a new version of Uniswap, that version of Uniswap would have no liquidity in it. Therefore, it would be completely valueless. The only way it would ever have value is if people moved liquidity from prior versions of the protocol to that version of the protocol. As a result, right, that clearly demonstrates that the network effects of that system accrue to the protocol and not the company that deployed it. And that is a very key distinction for the overall risk profile of the underlying asset.
But Miles, in fairness, I'm sorry,
we just pause for one sec. I want to try to get some of the, and Louis, you're shortly in the queue, so you can kind of refresh on that. So we got about 10 minutes. So I'm going to ask everybody to be quick in terms of their responses, and then we'll have the break, and then we'll have after the break, and we'll figure out to make sure everybody has a chance to get their thoughts in, and then we'll go to the questions that have been submitted. So let me, if Louis, you can just hold off for 1 sec, and Teresa, let me go to you, and then to John, and then to Collins. We can be quick, and then we'll see where we are from there in terms of timing.
Thanks. So a couple of things I just think are really important to think about is Howey was never intended to regulate an entire industry nor technology. If you look at what it was originally, it was more kind of these one-off situations. And after we saw, like, what was happening in these new assets, and the 21A report, indicated that, and how the commission was approaching it. From there, once you see that this is an entire burgeoning industry, Howey is not the appropriate test, in my view. And I think that that's when you have to start thinking about what is this, and just like we have historically throughout our entire through the United States just being in existence, how we've handled these things, it would be, start thinking about how to apply, what should apply, think more about what these assets are. And then I question the responsibility, how responsible it would be to just let this play out in the courts, this test that's very, movable, no limits. It's had problems before the digital assets industry, and it's going to have problems afterwards too. And I think we can also look to, there are other aspects of the securities definition that are triggered by digital assets. Yes, it's most often investment contracts, but absolutely 100%, no way does that cover all of them. There are other types that are not an investment contract, and I think that's important when you're trying to figure out how you're going to analyze these. And I also think it's important with people talking about the tripart mission, the tripart mission is very important, all three equally important, and that all of those were supposed to be done while mitigating or minimizing intrusion to legitimate and honest business. And if you look through, particularly from the Thompson bill, and I'll wrap up, the Thompson bill, which was rejected because it was too onerous, and you look at how that evolved into the 33 and 34 Act and Roosevelt's statements, all of this, so much focus was on the fact that it has to be minimizing that effect on honest business. And I don't want us to forget that, because we have forgotten it for a while. And there are other instances we can look at, and particularly with people thinking that Howey applies to everything like this, is in the 50s.
She has a water right next to her. Take a sip.
In 1958, there was a trading stamps release. And those trading stamps, the little gummy stamps, and you put them in your book, and everybody would get these stamps, and they were worth like nothing, maybe a penny of that, And there was a $168, I think, billion market for these things, and there was secondary trading and all sorts of things with these little gummy stamps, and the issuers give them to the distributors, and then there were the merchants. There was this whole infrastructure, and the SEC opined that those were not evidence of indebtedness. They did not even consider Howey. 12 years after Howey, they didn't even think about it, and they rationed, if we were to regulate this as a security, well then railroad tokens, all these other things would fall in. And clearly the securities laws are not supposed to handle all of these commercial transactions. And so if an entire industry and technology of trading stamps evolved, we would have to come up with this whole new thing of how do we handle trading stamps. It wouldn't just be looking at it as a Howey test for every single time and letting the courts try and figure it out, coming up with different answers each time. And then there's absolutely no clarity, no fairness. And if you are going to hold somebody accountable, and I think of, you're wearing a white suit and you get sued by the SEC, now you have a black mark, you can never get it off. And if you're going to hold somebody to that, and they're going to have to live their life that way, these are people, and companies are full of people. All of this, let's not forget, we're all people, even though we're talking about technology. And if you are going to hold that person responsible, and then 2 months later say, "Oh, never mind, it's not a violation for anybody else," where's the fairness in that?
That is crazy. She's right, even though she's very parched.
Thanks. I'll be
dry.
quick. There's an elephant in the room to me. There's been the wholesale demolition of the crypto enforcement program, right? It looks like they've closed all the investigations. It looks like they're closing or about to close all the litigation, all the appeals. They've shuttered the crypto unit, given it a new name. They've shipped the head of litigation who did all of crypto to OIT. So is this pivot worth it? I get it. There's definitely a mandate. I believe that the president had a mandate with respect to crypto and wants to be the crypto president. And so I don't necessarily think that any of these steps are something that there isn't a mandate for. But I've taught securities regulation for 20 years, 15 years Georgetown law, almost 5 years at Duke. It's a total gray area, securities laws. If your idea is, hey, we want to make these laws clear, it's just not going to happen in any area. Yeah, I mean, but I appreciate the nobility of the goal. When I was chief of the Office of Internet Enforcement, before that, when I was special counsel for Internet projects, I was an Internet evangelist. I set up the first computer that the Division of Enforcement had with an Internet access and taught people how to use it. I met with e-brokerage firms almost monthly, just like we're doing today, to find out what we were doing right, what we were doing wrong, and really try to work out things that to make this disintermediation, that's what everyone talked about at the time, to make all that possible. It was exciting. But there were people out there selling Reg A offerings or Reg D offerings on Internet trading facilities and advising people to buy them. And it was like a driver's ed. Remember those driver's ed films when you were in school where they showed you every conceivable violation? That's what these were. So we sat around and we figured out how to get rid of those. I just don't see it as far as this innovation, whether it's a gummy stamp or equivalent to an American Girl doll or a Pokemon card or whatever.
You got me.
Is this pivot? Is this dramatic, unprecedented? Right? Let's all agree the SEC has never done anything like that like this in its history with respect to such a successful enforcement program. Is that worth it for this this technology? That ask yourselves: is it something that I really care about? And is this pivot worth it?
All right, so I'm going to keep us on time. I got a couple of minutes left, so here's what I'm going to propose. Collins was next. I think that's going to get us to time for the first chunk. What I have in the queue is Lewis, Ben, Sarah, and I think Miles. There may be someone on the panel at the break who tells me to get them in the queue as well, and I'll do that. I know that there's the effort, and we will take questions that have been submitted. We'll make sure that we are able to manage all of that, so we give that due time, and also make sure that you all have the occasion. So that's my list. If I missed you, tell me at the break that I missed you if you want me to add. But with that, to keep us on time, we'll wrap up with Collins, and then we'll take the break, and then we'll come back.
Sure, thanks. I think just two final points to respond to. So first, I think that this notion that it's impossible to come up with any type of guidance or framework it's kind of weak. I mean, I guess I'm in Washington, so I can say this in an inspired sense, but like we are America, like we put people on the moon and stuff. We can figure out how to write words to give people more clarity on paper. And I think there's two quick examples of this that came out of this kind of meeting that are almost obvious. So for instance, I think, Lee, as you spoke about kind of your point, one of the things that you kind of inherently did was start positing a vertical commonality test as part of your Howey analysis. I think you said something like, all of these tokens intrinsically link the fortunes of all of the token holders. That alone kind of indicates a lack of clarity that the SEC could start working on today. Right now, the SEC has argued both for horizontal commonality being required, pooling assets and bringing funds, and then vertical commonality, where it only requires that you have some type of intrinsically linked fortunes with the issuer. That becomes problematic if you're an issuer trying to figure out if you're already within that regime. One clear example, I think, to finally answer one of your questions, I don't know if any of us did, is what could the SEC do today? I think one of the first things is just start giving guidance as to where their views are, as to what their views are on the prongs of Howey. So to your point, is an investment of money satisfied when somebody receives an airdrop, but it's expected that they create a market for that token? For horizontal commonality or common enterprise, is the SEC's view that it can be either horizontal or vertical, or is it both? That type of guidance alone doesn't require that they come to a decision on what these assets are, but it does give us more predictability as to what we should expect when we're going through these analyses and not going through 50, 60 questions and that type of guidance. So I think that type of clarity, as well as guidance on what type of information is required for a system to potentially meet the type of standard that Miles might be promulgating, and I think that goes to my last point, which is those standards that we look at, and I think somebody else mentioned the original purpose of securities laws. I went back and looked at the 33 Act's first congressional hearing notes, and there was a Senator Sam Rayburn. One of the first things he says is, the goal of this act was to place on parity with management of corporations, the buyers of securities, and then the buyers with the sellers on the same plane as those sellers. And I think what Miles's point goes to is that when you have certain characteristics in a protocol or an application or something else, I think it inherently places on parity the purchasers of that token with the purchase of management. And so to the example that he gave, with Uniswap, your Uni token can't even affect the operation of this protocol. I think there are probably even easier examples to look at where you can say, look, we're looking at this, and at some point when they've lost these elements of control, management has just as much control. They're on the same level of parity as the same buyer. And that's why I think that some type of measure of control is probably the appropriate kind of measure within the context of our historical securities laws. So, yeah, I think we might have a minute for Lewis, but I don't know if Lewis.
All right, so we'll give 1 minute. So Teresa has a question for Colin, so we'll do that, wrap up in a minute, and then we'll have a break.
What are the characteristics that you're talking about that would implicate the securities laws?
Yeah, so I think, and actually, again, not to piggyback too much off Miles' paper, but they did a pretty good job of outlining, I think, 3 standards, if I can recall correctly. One was economic independence, and that economic independence is basically what I think he was speaking to towards the end. The other was, as you mentioned, with governance control.
Sorry, I don't get that. What do you mean by economic independence?
That's totally fine. So economic independence, I think, in the example that we were just talking about is, do the benefits and the economic benefits in particular inure to the benefit of the holders by virtue of somebody exerting continuous efforts, and that essentially becomes the essential managerial ones, or does it inure to the benefit of those people by virtue of the operation of the protocol, independent of the actions of that initial issuer? And so, for instance, when you look at a Uniswap, it doesn't matter what Hayden decides to do when he wakes up today. Like Uniswap's value is going to continue to accrue to the liquidity providers that provide liquidity onto the protocol by virtue of the fact that the rules automatically and consistently will always execute in that fashion. But to his point, if somebody launches Uni v2, perhaps they add some type of control mechanism into it, suddenly you don't necessarily have that economic independence. It may actually be the case that you're actually dependent on that issuer or that developer to continue doing something or refrain from doing something in order for you to be able to capture that value. And I think that's a good example of where economic independence becomes really critical. The other 2 elements, I know we're over time, I'd probably look at his paper or some of the other folks' papers up here. I think Sarah's done a great job at this, Miles has, and a lot of other people have written about that. But those 3 elements, economic independence, governance, and forgive me, Miles, I forget the last one, are probably 3
operational control.
Yeah, operational control. Thank you.
All right, great. So we are now, in fact, going to take a break.
Are they going to tell us how long?
Instructions?
This is live chill wave, yeah, but they're about to take a break. Take a break. And they're going to cut us out. Okay, they're going to take a break till 3:30.
Enforcement looking jackets. They are friendlies. They are no one to be afraid of.
I don't
They are
think
just
that,
taking your
this
cards.
person-
They will not report you to anyone.
I don't think this person knows that they're on mic right now.
I mean that. And the second
No, they
point
definitely
is,
don't.
I know we've been getting questions on the web. So please
Cowpoke.
continue to send those as well. We're monitoring them and we'll get through as many as we can. And finally, we will have a small snack break. So when you exit here, I see some joyful faces. That is also
Yeah, everyone's ready for a snack break. Yeah, what to say? What to do. This was unexpected, but very nice that this was today. I was pretty rough earlier. Wait. This person, okay, they're back off. This saved me today. We did an intro to this stream, and it did not actually start with this roundtable. We found that out while we were live. We had a good intro today with some important information, probably worth the 5-10 minutes to watch that today. These guys are reconvening at 3:30. That's in half an hour. Here's my issue. My issue is that right now I am supposed to, and I'm about to, but I'm supposed to be doing a Q&A, and like a new traders or traders Q&A on Crown Analysis or on Crown Crypto. If you go to joincrowncrypto.com right now, you can get a week trial. You can jump in there. You can join us. So I don't know. It wasn't really interesting enough to super follow this up into 3:30. Maybe we would if I didn't have to go do this Q&A, but I think this is more important and more interesting. Hate to leave you guys. Hate to leave you. I'm sure you can catch this elsewhere. This was just on the SEC's site. If you want the direct link, I'll put it in the regular Discord, discord.gg/TomCrown. You can check that out. That will have the direct link. I do love that you guys joined here. Yeah, this meeting, actually, I'm looking at the site here. It says it started at 1, which it did, but it says it goes till 5 p.m. We're probably not going to be listening to that many more hours of this. So I appreciate you guys tuning in on Friday. It's not a very spicy one, but we spent it together. We're going to be live again Monday. We are live Monday, Wednesday, Friday here at about 1 p.m. East. We're live in days in between. If it gets really interesting, we'll go live emergency spice style. And I think that's it. I think that's it, guys. Make sure you join the Discord, discord.gg/TomCrown. It's free. You can use any of the links in the video description below, and you can get into the VIP sections in that Discord. I'll be in Vegas in May for Bitcoin 2025. You can join me there. Link is in the video description. A lot of good stuff. And now I think I need to jump off and deliver this Q&A session in the Crown Analysis Discord. So, guys, I will catch you soon. Thanks for making this a better morning than it was going to be. Really no updates on the chart. Not a lot's happening. That'll come to an end